You've had a profitable year, but somehow you end up with less cash than you started. What gives, you may be asking. This happens all the time. The numbers say you're winning, but then it feels like you're drowning, and the cash flow is different than the reality of the profit and loss. Profit is what you've earned. Cash flow, though, is what actually ends up in your bank account and what you actually feel. So today we're going to talk about the differences of those things and why it can sometimes feel like your profit is lying to you. We're going to start with what is on the income statement. An income statement is a reflection of revenue minus expenses equals net profit. All expenses fit into different categories, and that's the detail that you see on your net income. But the problem is, depending on how you do your financial statements, revenue and expenses are not a reflection of all the cash flowing through the business. This is especially true if you do accrual-based financials. We're not going to talk about that here, but we will have videos about that in the future. To better understand the cash movement in the business, we need to look at the statement of cash flows. The statement of cash flows is a reflection of the movement of cash during the period of time that you're looking at. So we take the net profits, and the net profits are actually a function of operating cash flows. And so we have three types of cash flows in a business. We have operating cash flows, investing cash flows, and financing cash flows. The statement of cash flows is a reflection of beginning cash balance plus or minus the changes in those three types of cash flow, and then reflects that ending cash balance. It's a statement of cash and non-cash movement on the income statement and the balance sheet. And so it brings those two other statements together. So let's talk about the sections of the statement of cash flow. And this is going to answer why your profits may not match what you feel. That first section is the operating cash flows. And that operating cash flow is made up of your net income or net profit. We'll use those two terms interchangeably. The non-cash charges on your income statement and the changes in working capital. So let's talk about what those two things are. The non-cash charges are most likely depreciation and amortization. There's a few other things that can be non-cash charges, but that's truly what most people are going to see on a regular basis. The changes in working capital are the cash movements that are reflected in the balance sheet. So that is most often AR and AP and inventory. Inventory is key here because as you grow, inventory dollars are used to buy more inventory to fuel that growth. And that's why through a growth period, that plus not having collected on AR is why you feel a cash crunch during a growth period. Next, we talk about the investing cash flows. The investing cash flows are a function of capital expenditures and acquisitions. Sometimes there's maybe some investment income, most likely not in your business. Acquisitions are kind of one-off things, and so we're not going to focus on that here. We're going to focus mainly on those capital expenditures, and those are the things that you're buying to keep the business going, but have a life more than that single year. Those capital expenditures can be equipment, it can be vehicles, it can be facilities, it can be all sorts of things that, again, help you continue on into business into the years in the future. This is where, going back to those non-cash charges, where you see depreciation. Depreciation is an attempt to reflect those capital expenditures on the income statement because so many people do tax-based depreciation and record that on their income statement. They often show wild swings, whereas depreciation done on a true accrual basis is going to spread that asset out over the life. But again, that's not the cash impact. Last, we have the financing cash flows. These are the cash flows that are related to the taking in new debt or paying down debt. And then the dividend or draw or owner's distributions cash flows. So when you pay down debt, when you distribute money to the owner, that is using cash that's not reflected on the income statement. So if we pay down a significant amount of debt, that is going to mean that if you had $1 million of profit, you pay down 100,000 of debt, you're only going to have 900,000 of profits available to you to spend. Obviously, that's only two variables. There's a lot more that go into that. So when we go through the income statement, remember, we're only getting part of the picture. And this statement of cash flows is what you really need to show the cash movement. If you're doing cash basis financials, the statement of cash flows isn't going to show you anything different than what you can see on the face of the income statement and face of the balance sheet. It's probably not needed, but for people that are on accrual, the statement of cash flows is a key statement that's really important to look at. So when we bring all of this together, what we see is the movement between the three different categories. And we want to generate profits from operating cash, from operating the business. We then want to reinvest that into the business through investing to, again, help grow and create more operating cash. And then we sometimes want to use debt through the financing to fund investments or operations. But then ultimately, we're bringing in cash from operations, paying to invest in the future, and then sometimes removing money in excess of what we need out of the business through distributions or through debt paydown. And so when you think about that, you think money comes in from operations and then it is allocated to those other two based off the goals of the business. And so when you look at that big picture, it can get complicated really quick. And that's not necessarily a problem. The problem is that people don't understand it. And so our goal here is to help you understand it. If you want to go deeper in this, I am doing a cohort that we are calling 5 Days to Financial Clarity. Over a 5-day workshop, we're going to walk through how to understand money flow through your business, the levers, the financial levers that you need to drive profit, how to fix and better understand your cash flow, and then how to figure out the things that you're going to measure. Ultimately, we're going to walk away with a 90-day plan to get you more cash and profits in your pocket. And if we don't do that, if we don't help you find that, we will refund you your money because, again, that is the sole point and purpose of this cohort. This is coming in January, but we're going to do this all throughout the year. So no matter when you're watching this video, know that this is going to be available to you. Use the code YouTube to get a discount on the cohort. Look for the link down in the description. And again, I hope to see you in the class. Thank you for watching. And until next time, hold on to that profit and turn it into cash.